Hey, Patrick Vernon here, author of Venture Capital Strategy, How to Think Like a Venture Capitalist, with a quick video about the differences between Shark Tank and real venture capital. When I started teaching my VC class at UNC back in 2006, I would bring in founders to pitch to the students. And lo and behold, 3 years later, somebody done stole my idea and made a hit TV show out of it. So who's the sucker in this scenario? Amazingly, 15 years later, both Shark Tank and my class still exist. And I love that Shark Tank brings a lot of student enthusiasm to bringing innovation to market and how do you fund a startup. But there are some confusions there because one of these two things is a television show, people. Let's start with the different types of investors that they are. Those folks on Shark Tank, them's rich people, and they can invest in anything they want for any reason. That's called angel investors. Presumably they invest to make money, but they can do anything they want. They're beholden to no one. They've got their money and they invest in startups. VCs, on the other hand, are either partners or employees of a venture capital firm. They will raise a fund to invest in startups, and the money for that fund will come from institutions largely. We're talking endowments, foundations, corporations, banks, any entity with a big chunk of money, they want to put a little piece of it in this alternative asset class. So the venture capitalists are the professional money managers who manage that money, and they have a fiduciary duty, very different than angel investors or sharks. And what are they investing in? Well, on Shark Tank, they have all those really cool consumer good looking things that are super fun to learn about on television. And you can easily understand them in a 10-minute segment. VCs, on the other hand, invest in disruptive technologies, really cool ones a lot of times, like the ones you see here, which you've probably heard of, and the 5 of them on the right are some of the biggest companies in the world. But over the decades, VCs have invested in hundreds and hundreds and hundreds of technologies that you just could not explain in a really quick television show. Which brings us to the 11-minute segments. That's really highly produced, great TV, very entertaining, but it's not very realistic. So it's probably no surprise that almost half of those deals don't actually even end up getting done because you can't really do due diligence that quickly. Due diligence is so important in the venture world. It takes up more than half of my book. And if you're really interested in this stuff, you can go to vcrazor.com to see more of my vcrazor framework. Suffice it to say, for this 7-minute video, it's going to take more than 11 minutes. It takes days at the very least, and could easily take months for founders and venture capitalists to come to deal terms. So lastly, my favorite part, let's get into some of the loosey-goosey math, partly because it's fun and also a good intro into venture math and how venture math works. And again, if you're interested in this going more deeply, I have another video that goes into it at vcrazor.com/invest. So why do I call it loosey-goosey? Well, on the show, you see an offer that's, blank dollars for blank percent of the company. And that makes it sound like the sharks get a piece of the existing company, like the founders sold a piece of their company, and the founders get the money and they could do anything they want to with the money. And that's not quite the way it works. They're kind of glossing over some things. The sharks do invest money, but they invest it into the startup, and then they get a piece of the resulting sort of slightly larger company, and it's larger by the amount of money they just put into it. And it's true that the founders control that money, but they must use it to grow the company. So founders should say, if you want to be technically correct, they would say, if you invest blank dollars, you will end up owning blank percent. So let's say for $1 million, you get 33%. Looks like a kind of typical, maybe slightly big shark deal. Now, venture capitalists look at it slightly differently. Rather than negotiate the percent ownership upfront, they negotiate the pre-money valuation, which they call pricing the deal. So you take the investment size, that's the same, let's say $1 million from that last one, and if you negotiated a $2 million pre-money valuation, you end up with a $3 million post-money valuation. The difference there is just the investment size, right? You put the cash into the company, so the company is worth that much more. So same thing is true with the shark deal. If it was $1 million for 33%, it would look like this. So sharks would call that, I'll give you $1 million for 33%. That would be their offer. In VCs, the exact same deal, I'll offer $1 million for a $2 million pre-money valuation. Those are exactly the same deal. Here's where it gets loosey-goosey. So it's an accurate thing to say $1 million for a 30-year company. What's inaccurate is then when the sharks extend that to say, you're valuing your company at $3 million. And the poor entrepreneur is sitting there sweating, trying to figure this out under the hot lights of television. This is a false statement. Why is that false? Well, let's take a quick look. If you wanted to be accurate, the shark could say, you're valuing your company at $3 million post money, or you're valuing your company at 3 million after you get my million. A lot of times my students will say, this is just semantics, right? You just say 3 million post money, pre money, what's the diff? Well, the difference is 50% valuation. And we'll see here, it does beg the question, is this lazy or is it a lie? So if my students are right, maybe it's just semantics, then it's just lazy, because 33% of the company for 1 million, you do the math in your head, 1 million is 1/3 of 3 million. So yeah, you're valuing your company at 3 million sounds about right. That's slightly easier / lazy math. However, it does very much benefit the investor, and that's where it gets a little bit nefarious, right? The difference between $2 million and $3 million is a big difference. And again, the founders are sweating and trying to negotiate this in real time. And with venture capitalists, it's also a difficult negotiation. So I think it's disingenuous at best to be using post money here confusingly. And so that's where it gets a little loosey-goosey. This is all in the context of my book of what I call the VC job cycle, and investing, and of course, is a very big part of being a VC. These are the other things covered in that chapter. And no surprise, that is the longest chapter of the book, because that's one of the main things venture capitalists do. If you like what you're seeing here, please do me a favor and give me a like. And also, if you're feeling very generous, put your favorite Shark Tank episode in the comments, and I will update my syllabus next semester with some new Shark Tank episodes. Patrick Vernon again, thanks for watching.